Welcome, everyone, to Real Estate 360 Live. I am your host, Ryan Sloper. For those of you not familiar with the program, my guests and I will cover every angle of real estate under the sun, from interest rates to the economy to what's happening in Washington. Anything that affects our local real estate markets will be covered here. If you got credit issues, you can call me. If you're looking to buy or sell your home or in a distressed situation where you've been struggling to get a loan modification and it's not working out, and like to know what your options are outside of, continuing to go down that path of waiting for the bank to respond to you and your modification, reach out and call me. I've got solutions for you. If you're looking to refinance the lowest rates in U.S. history, reach out to me. We'll put you in touch with our preferred mortgage partner that'll help you refinance or purchase your next real estate transactions. You've got the questions and I've got the answers. Make sure you tune in and join us every Monday at WNEW 1580 AM from 2 to 3 p.m. in the afternoon. Like I said, if you have any questions, please call the off-air phone number, which is 877-245-2030. That's 877-245-2030. Or via the web at realestate360live.com. That's realestate360live.com. Remember, if it's real estate, it's covered here. Got a great show lined up for you guys today. Joining me on our panel to discuss the many issues of what happened last week in the markets, as well as what's on deck this week that can affect you and your real estate decisions, is Louis Cammarosano, who is the general manager of HomeGain. Louis is often cited in the media as an industry expert in the Wall Street Journal, Forbes, CNN Money, Fox Business, Smart Money, MSN, and numerous others. Louis, how you doing today, buddy?
I'm grand. How are you doing?
Can't complain, Louis. Just,
Right.
It's a pretty neutral day today. Not too much going on as far as the markets are concerned. Obviously, over the last couple of weeks, Louis, the interest rates have taken a turn for the worse. They've actually they've risen probably anywhere from 1/4 to 3/8% over this period of time. And like we discuss all the time, Louis, is we say that there's so much room for rates to get worse versus getting better. And I think that we've seen that over the last couple of weeks, and I'm kind of glad that this has happened, because what it's forcing people to do is recognize and be cognizant of the fact that you can't time the market perfectly. And for people that are sitting on the sideline saying, I'm just going to wait until I get that perfect rate, they've got it in their head that they have to hit, a 3 1/4 or a 3 1/8, whatever it may be. We get the shift upwards. It could take us months to get back where we just came from. And I think at the end of the day, you can't get too greedy when it comes to the already super low interest rates. Would you not agree, Louis?
I agree 100%. You can never, no one, even the most professional, the best stock pickers, market timers, never get it 100% right on the dot. I mean, we have low interest rates. They're a good bargain. If you're in a position to buy a home, it all makes sense for you economically, then waiting around to try to get 1/10 of a point is kind of ridiculous, because these rates are, as you mentioned, artificially low. They're not going to stay this low forever. And they really, even if they stay low, the Fed managed to keep them low for another year or two, they're not going to go much lower.
No.
All that can happen is they can go up and you miss out.
I would say that there's probably, a larger percent, a 90% chance that the chance is that these rates are going to go higher versus going lower from where we just came from 3 weeks ago.
And if they do go lower, how much lower are they going to go, Ryan?
An eighth or 1/4. I mean, at the very most. Like I said,
not
because
much room left.
No, there's not much room. And what I think many are failing to see at this point in time is that the banks are worried about their bottom line. So they're not going to, even if, the money that they're able to borrow money and lend it out, they're going to hedge. They're not going to pass that on to other correspondent lenders. They're not going to pay them as much money.
It's just not worth it to lend once it gets so low.
I mean, who wants to lend at 3.5 or lower percent? It doesn't make financial sense for the banks to do so. They'd rather hoard that money, keep the banks on their keep that money on their balance sheets, and go out and make a little bit more risky investments in the stock market and try to make 6, 7, 8, 9, 10%.
Of course. And the other thing, Ryan, is I think people are not buying because they're hoping home prices will go down. And, they may go down, but if you're buying a home to live in for 30 years, you talk about this week in and week out, you lock in your cost of shelter. It really doesn't matter if the home price goes down a little bit over the next couple of years if you're not selling it.
Yep.
Basically, you are locking in your cost of shelter in 2012 dollar prices, when you know in 2016, 2017, that going out and renting or buying a home and taking out a mortgage is going to cost you much more monthly than it is in today's terms.
And I'd actually make the argument, Lewis, that there's a lot of people. Obviously, the stock market is rallying right now, which is mind-boggling to me once again. Obviously, there's a lot of money being flushed into the system. There's consumer sentiment seems to be a little bit better heading into this election, which is exactly pretty much what I thought was going to happen. I'm not really changing my stance on that. That is not necessarily an indicator of where we are as an economy, because overall, there's still the middle class and the lower class are still struggling.
Sure, but lower interest rates encourage stock market investment. So if you've got more money flowing into the stock market, then the stock market's going to go up, irrespective of the underlying fundamentals of the companies that make up the stock market.
Absolutely. But more to the point, Lewis, is that the average Joe looks at the stock market and assumes that everything is peachy. Yes. They just look at it and they just take it for face value. And I'm really urging people to look more into this today because, I've been getting the question a lot lately. Okay, we have this impending election. What does that mean for interest rate? What does that mean for real estate? Where do you see real estate prices headed? And to be honest, I don't think anybody can tell you what's going to happen, because if we fall off this fiscal cliff that we're heading almost over at this point, things could unravel really fast.
Well, Ryan, here's the contrary one. You say that the average Joe looks at the stock market, sees it going up, and takes for granted that the economy is doing well. Well, just the other day, George Soros sold off all of his equity positions.
Yeah.
We all know who George Soros is.
Yep.
He's a major financier who dumped all of his equity and purchased gold.
Yeah.
Okay, so these people generally front run what's going to happen. You hear about all the cases of people who sold their financial stocks in 2008 prior to the collapse.
Yep.
They knew it was coming. So I don't know what you can read into George Soros's stock trading, but generally this type of move it's pretty dramatic to get rid of all of your equity positions.
Not just that, Lewis. I mean, if you couple that move by George Soros with the other move by Lord Rothschild betting on the euro collapse, he basically took, I want to say it was basically another $200 million bet against the euro currency that it will collapse.
Well, that makes sense, and they go into gold, and John Paulson too raised his stake into gold as well. So the reason people move into gold, for our listeners, is when they lose confidence in the underlying fundamentals of the stock market or of the currencies that they're traded in.
Absolutely.
And generally, the public is far later into the game when there's a movement into gold and silver. You generally see the larger investors front run this.
Yeah. Now, obviously, we have a lot of prognosticators out there, economists, and I mean, obviously, their opinions are varying across the spectrum. My thing is that you can really take and protect yourself from having to worry about at least the cost of your shelter, by buying a home at the low interest rates right now. I can only give you advice as of today. I can't give you advice after the day after the election or a year from now, because so many things can change, and they can change very rapidly, as we've seen with just the interest rates over the last 2 weeks, moving up 1/4 to 3/8%, based upon a lot of the national surveys that are taken of interest rates that people have gotten by Freddie Mac and Fannie Mae. So much can change in just the course of a couple hours, of a day, a week. A year, is way out. I actually had a client not too long ago that asked, well, do you think that I'm going to get my money back out of this house if I buy it at X price? And I said, you know what, that's really the wrong question to be asking at this point.
Absolutely the wrong question.
You know what I mean? And I think that's the question that got us in the mess that we were in to begin with.
The only person who should ask that question is somebody who's managing a portfolio of homes that they're selling, flipping, or so on. You're buying a home to live in. Trying to get your money back in a year doesn't make a lot of sense.
No, and you know what? There's a lot of people out there, I include myself one of them, that like to invest in real estate, and there's sound ways to do it. Can you make money flipping homes? Yes. Can you make money investing in real estate? You basically buy and hold, where you're buying it and you're holding it for an extended period of time. You're locking
or
in.
Renting. Or renting.
Exactly, and renting them out. You can make money doing all those things, but it has to be smart, and it has to be a very measured decision that you're making. It can't just be, am I going to get my money back out of this? Because you know what? You might get your money back out in 6 months. It might be a year. It might be 10 years.
But Ryan, it's ridiculous. If you're going to buy a home, that home is for you to live in. The making money on it should be a secondary consideration. Anytime you buy an item that you want or you need, like a car, you don't think, can I resell the car in 3 years and make money? You're buying the car because you need a form of transportation. And presumably you buy the car that you like and the car that makes sense to buy economically. That's what people should also do with homes. If they're going to buy them, they have to remove from their conscience that somehow you're supposed to buy a home, it's going to go up and you're going to make money. They should be looking at buying a home because it makes sense economically to buy it because you're going to live there for a while.
I totally agree. You're listening to Real Estate 360 Live. I'm your host, Ryan Sloper, joined by my guest, Louis Cammarosano, the general manager of HomeGain. You know, Louis, it's interesting because, you know, I think people have really don't remember what we just went through as of a couple years ago. I had a couple other people say to me that, you know, hey, you know, my buddy just told me that he bought a house for $200. Now it's worth $230 in less than a year's time. I really feel like I need to get into the market so that I can buy. And it speaks more to the point is that, you know, as a nation, it's almost like, you know, there's this herd mentality where it's like one person says one thing and everybody else follows. And that's the worst thing that you can do.
But that's what happens, Ryan, in all bubbles. You never learn the lesson. You go through the stock market bubble. You go through the housing bubble. And, of course, the next bubble comes along or you reinflate the old bubble. Everyone starts to think, oh, it's different this time. It makes sense. It doesn't. It never makes sense. But that's part of the psychology of the market. There's always people that are going to try to get rich quick, and they're going to try to jump on the bandwagon. And they think now, oh, the prices are low enough now. They're going to go back up to where they once were, and I missed the last housing bubble. I'm going to buy now and get on the next one.
Yeah, there is.
And that may or may not make sense at all. And really, if you think like that, you might as well just go into the stock market and buy penny stocks.
Absolutely. You know, I mean, and I think that, you know, there's many instances that, you know, somebody can get into real estate and get lucky. But just think about the last bubble that we had. Those people that, you know, were able to
get homeless too.
Right. Well, they let's say they sold at a high point and were able to get rid of their home, made a boatload of money. Unless they actually took that money and went and rented somewhere else, that's the only way that they could actually profited from that. Because otherwise
they would have bought another house at an inflated price.
It dumped that money back into it and then couldn't get it back out. So
what would have helped, though, if you could have moved? For example, I know someone who did this. They weren't trying to do it. They had family reasons to do it. They bought in California in 2002 or 3. They sold in 2005. They made a lot of money, and they moved to Texas, where they can buy a house for a lot less. So they made out.
And you know, and unfortunately that was back during that bubble. It was like everybody had the supersized mentality where it wasn't, you know, let's kind of downscale or move somewhere else. It was let's move into something bigger or more, you know, above our means.
Right. I knew another family lived in Southern California. They were immigrants, and they moved up 3 times. So by the time their last home, I don't know whatever happened to them, they moved from a $220,000 house to a $550,000 to a $950,000. And by the time I lost contact with them, that home was worth $1.2 million, which is probably not worth now. Who knows if they've moved up even more after that?
Yeah.
And finally got stuck with a $2 million mortgage that they couldn't pay.
Yeah, and so the biggest thing is, guys, now worry less about what the property value is going to do in the next 6 months, a year, 2 years, 3 years, and be more caught up in the fact that you can lock in your cost of shelter long term to protect yourself. I think now is an important time to talk about protecting yourself from all of the economic things that can go wrong.
Oh, and so many things can go wrong. If you have a collapse of the euro, you have all these different issues with the United States debt. Eventually, interest rates are going to rise, and your house price may go down as a result of that. But you've locked in your cost of shelter, and at least that's one economic issue you don't have to worry about in your daily budgeting. Because if all these things happen and there is some type of financial collapse, the prices of oil are going to rise, the price of food is going to rise. At least you won't have to worry about the cost of your shelter. Which is
one of your biggest expenses. We're coming up on a break. When we come back, HUD is selling off 9,000 plus discounted loans. And I'll let you know to who when we come back. Stay right there.